Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
G'day, how you going? Phil Tarrant, today's host of Broker Daily Uncut. Welcome back to the studio. They've dusted me off after they put me in retirement a couple of months ago, and unfortunately the talent in this show is out of the office today, so they've asked me to jump in and have a chat with co-hosts Eva Loisance from Finney Mortgages to chat through what's going on in mortgages, give some commentary and insights into the market, the stories that we're seeing, and get a broker interpretation on it, which will be pretty cool. Eva, how you going?
Eva, yeah.
Eva?
Good, thank you.
Yeah, what's been happening? This is the first time we've been on this show.
Yeah, actually.
Do you enjoy it?
Yeah,
Broker
it was
Daily?
good, yeah.
Is it better than the Smart Property Investment Show?
Well, a bit different, obviously. The audience is not the same, so it's a good way to actually show and explain what we do on a day-to-day basis.
So, Broker Daily Uncut is a show for mortgage brokers. You're a mortgage broker, so you're giving a view towards it. You're in the trenches. You're working in and around this every single day with clients and building the team at Finney Mortgages. You see a procession of bank BDMs coming in to see you guys all the time to tell you about what's happening and keeping you updated and informed. And I know that you love reading brokerdaily.au every single morning. It's where you get your information from when it comes to mortgage broking. Are you enjoying being a broker at the moment?
I've always, I love it.
Yeah, it's tough. It's a tough work.
And it's challenging, but I just like to find the answer outside the box and the rewards that comes from that.
Yeah, that's cool. And I watch you guys operate. You do it very well. I use Finney as my mortgage broker, and I'm doing a whole bunch of refinancing now and getting some stuff in place. So if you can give Rebecca a little nudge for me, that'll be handy.
Yes,
I'm hungry and aggressive. But some stuff I've seen coming through and across my desk, which I thought I'd get a bit of sense from you on and get some contents for mortgage brokers around it, because no doubt a lot of you out there are aware of these things, but potentially not giving it the emphasis and focus that it is. And one is a story that I saw through it's inside of the Momentum Media Network from a Smart Property Investment. It said half of all buyers still shrug off cybersecurity risks, even as scammers target property deposits. Now, a couple of points on this. 50% of buyers remain unaware or unconcerned about cyber threats during the transactions. Scammers are increasingly targeting deposit transfers, often misrepresenting agents or conveyancers to redirect funds. They use emails spoofing to send fake details. So you've got to be really across this. And it's surprising how often people, I still hear about this sort of stuff. And when you think about the ease of intercepting large amounts of money through transfers for property deposits, there's a good reason why the scammers see this as an easy target.
And it works. And I've heard of it. I've seen it. I know people that have been, unfortunately, victim of it. It's very easy to get caught.
Yeah. So essentially what happens is a buyer will be told by their solicitor or conveyancer, there'll be some very important official-looking documentation saying, can you pay...
Not even, it's an email sometimes.
Emails,
this
pay
is
the
the
funds into this account here. And what's happened is that a scammer has corrupted the conveyancers or the lawyers' email and got into their system and are representing themselves as the agent or the conveyancer or the lawyer. So this does happen. There's a couple of ways around it. Are you sort of hyper vigilant on this? Is it something you really sort of drive into your team?
We do not get targeted as bad as lawyers or solicitors because we never ask for people for money. That's not what we do. So it would be very, I guess, unusual for a broker to say, hey, transfer a huge sum of money, which is sometimes, the whole deposit of property to a broker. That's not how it happens. So it's more generally the solicitors that are targeted. But often what they do is they copy in the broker with instead of putting like Eva with an A, they would put an O, for example, and they would go to a different email address. So it looks all legit. And we don't have visibility of it. Obviously, I don't get those emails. And it looks, people just transfer money. And sometimes people that have been buying properties that should be aware of this, what people should do is always call and check the number. and it's devastating when people can't settle.
Well, you imagine, like, because it's very hard to get the money back. The bank just goes,
Well,
well,
no chance.
sorry, it's like, I'm afraid, like, scammers know what they do. That money's gone. It's gone straight away. And
often it takes days to realize what's happened.
Yeah, I know. And they go,
because people are like, I've transferred the money, it's all good, it went through, whatever. And
yeah, I was involved in a transaction recently, and we did all that. We sort of confirmed it in writing and in call, and then we did a $1 transfer just to make sure that you actually had the right account and the right details and the money
and it
arrived
sounds
in
over
the account.
the top, but
you've got to do it. You're putting hundreds, if not millions, of dollars transferring through these things. It's you got to make sure you get it right. So for all those brokers out there, if you're not encouraging this discipline and diligence with your customers, you will get caught out at some point in time, and it's very, very hard to get these funds back. It's gone. You think about these people who are saving for a dream home, and then it's gone in a heartbeat.
Yep, I've had a client years ago who likely had parents to cover what he had lost. Otherwise, he would have not only lost, I think it was 190,000. That plus also couldn't settle on the property, so he would have lost the property as well.
Yeah, there you go.
So
it's hard to find another 100. That means he's paid 190 times 2 because of a small mistake with getting scammed, and people say it's not fair, and it's not. But unfortunately,
they transferred the money.
This is the world
from
we live in now.
Yeah,
this is the world that we live in right now.
Yeah. So it's easy for brokers to just tell a client, you're gonna have to transfer money. Just give a call to your solicitor.
Yeah,
make sure the numbers are right. And often it's the same number that you would have transferred money into the first time. If the number changed, question it.
Yeah. Last minute changes of banking instructions is always it's always a telltale
red flag,
that something's not going wrong, something's not going right. So beware. Some other stories here, but we'll just go to a quick break. Stay with us. Back in a moment. Welcome back. Phil Tarrant standing in as co-host for Broker Daily Uncut with Eva Loisance, principal at Finney Mortgages. Now, some other stuff, Eva, that I wanted to sort of chat through with you. And there's a story here also. It's more of a consumer story. It was for property investors and home buyers, but it was, beyond loan approval, why old lending models fail investors. So this is the idea of maybe what you have done and have yesterday or previously to sort of drive forward your journey as a property investor by leveraging finance might not necessarily be the way to move ahead with. It says many banks and lenders still rely on static one-size-fits-all assessments focused on initial loan approval. These models often ignore the long-term financial strategy and evolving needs of property investors. We're going to chat about this on another show that we'll do for property investors. Investors are frequently locked out into unsuitable loan structures, limited flexibility and growth. They often fail to support expansion. So this is a key thing for brokers, and this is the sophistication of the mortgage broker to be able to delineate the objectives of a customer and then work out, if you just go one size fits all, this is what I've done for everyone else, let me just do this because it's simple and easy, that's probably not the right outcome that you're going to want for your customer.
Yeah, and it's still, we discussed this in the SPI show many times. We still undo a lot of, I want to say, bad work that has been done by a bank or another broker. Thinking of just the one transaction in front of you, it's very short-sighted. When you talk to an investor that might do so many other things later on, need equity, need expansion, need valuation, needs to refinance every now and then. And even though we've talked about that for years, crossing properties is still something that happens a lot.
It does, and there can be a case for crossing.
It can be.
Sometimes.
I'm not saying never, but...
Yeah, sometimes it can be a case for it, but I know most brokers that I speak to that work with investors, they spend a lot of time uncrossing and deconstructing poorly constructed portfolios. And investors do get tapped out and capped out sometime. And there's another side to this coin though now where it's getting a bit of a free for all in terms of brokers setting up investors in trusts maybe a little bit too early and unnecessarily and because of some of the advice certain property investors may be getting from advisors, maybe unnecessarily overcomplicating their portfolio and or maybe getting sort of misled in some ways as well, right?
Yeah. What I see a lot is obviously buying in a trust for I guess, servicing capacity. The whole point of buying in a trust, because there's no negative gearing, is that the property would be positively geared. It's very rare these days that people will have positively geared property from day one.
Yeah,
It would take years.
80 or 90%. Yeah.
It would take years, exactly, especially at 90%. So it would take years. So the whole purpose of doing this is completely non-existent for years, and they're missing out on the negative gearing if they bought a property under the name. So there's lots there that sometimes just doesn't make sense.
Yeah, so be careful. Brokers out there who are maybe getting led by a customer who may not necessarily have the right knowledge, and therefore they're making their decisions in a bubble of misinformation, because brokers obviously have best interest duty, as the obligation is to
but
ensure the
it's
customer.
not our role to advise on buying through a trust. That's not
not
our
your role.
No, that's
it's your
not.
role to find the most appropriate mortgage.
Yes.
Yeah.
Yes.
Based on the information that you receive from the
based on
customer
what the
and all their
client is telling
advisors.
us. All I can say, yes, you would service better in a trust or in your personal name, or have 50-50 with your wife, whatever it might be. I can't say it's better for you to do this or that, or I advise you to do this or that. So technically people should get financial advice. Do they get it? I don't know.
Did you come across many consumers that are maybe operating under misaligned advice from other professionals, and it might be a financial planner or a buyer's agent or someone else, where you just say, this is not right? Does it happen?
Yeah.
Does it?
In my opinion anyway. And again, I'm not a financial planner, I'm not an accountant, but when you see people setting up trusts that cost like $5,000 sometimes or more, depending where they go, and we know the property they're buying is not going to be positively geared for years.
Yeah. And when you say to the customer, look, this is probably not the right thing to be doing, do their advisors get on the phone saying, just do it as I've told you to do it?
Yeah, what's sad sometimes, or good for them, I don't know. I don't know how to think about that, but they also get accountant or financial planner to just say it is positively, and even if it's not. So at the end of the day, yes, they can keep going, they can keep borrowing money, but they have to remember they are the one paying the mortgage, and if it's not positively geared, there's going to be a shortfall somewhere.
It gets caught. It gets caught at some point, and we
I don't
have
know
to,
how long we can. Yeah.
Look, and I sort of speak quite a lot about this. You've got to be careful where you take your advice from, and just this idea as an investor, just accumulating as many properties as you possibly can is the game. Is it necessarily the right focus for many investors? And they can find themselves again in really complicated, unnecessarily complicated structures. Most property investors end up with between one or two properties, right? That's the way it is. So to actually be holding them in a trust, if it's not for other purposes like asset protection and all this sort of stuff, if it's just because you've got dry powder to, inverted commas, continue to buy property because you've got your finance clustered into these specific buckets, and therefore the bank will look at them differently. I know banks are really clamping down on this stuff, and I know the regulators are really clamping down on this stuff as well. So,
yes, that's true.
Yeah. Story here, and it's more of a catch-all. This was also on Smart Property, first home buyer activity to bounce back after flatlining. It was steady for quite a long time. And first home buyer activity sort of spikes and troughs depending on government incentives and stuff. But you're seeing a lot more in the market now as a result of all this incentives.
So obviously the scheme that came into effect in earlier this month, and rates just being lower and potentially declining still. I think that gives a bit of fuel, and I think there's a bit of FOMO too. Yeah, going on.
Oh, there's a lot of FOMO, right? And this is, you've got rates which have come down from their peaks, and to your point, maybe some initial cuts happen in lockstep with stabilising rates, but it's been subdued because of this positioning around higher rates and affordability. The scheme isn't making property more affordable.
No,
you might be able to buy your property that you want earlier than originally you could have. However, in relation to affordability is just not what the price is. It's the mortgage repayment connected with it.
Yeah, that's right. And I think that the scheme, if you get in now, let's say until Christmas, you probably could do all right, buy a property that hasn't been overpriced. But if you get in a year time, or the prices would have gone up quite significantly by the time you get in. So
And this is the argument, right? Yeah, Treasury modelling said that this scheme would
Yeah.
only put a tiny sort of fraction of a percentage on upwards, but it's already
you
driving.
already see the difference.
Yeah, I think people look. In relation to the scheme, I think early movers will get the benefits of it.
Yeah, that's right, exactly.
But
It's now never, and otherwise you backwards again.
it's not going to make property more affordable in the long term. And what will happen in time, and wait sort of 18 months, 2 years, where people who are buying under this scheme now, there'll be a new term for it. It'll be like it won't be a mortgage prison, because that was more of because my serviceability didn't stack up and I couldn't get a new rate. There's going to be like this
security prison.
Yeah, it's where people are going to feel stuck and constrained, because they've probably gotten to the market earlier than what they would have at a much higher
loan that they can afford.
Loan that they can afford. And when the reality sets in,
Yep.
that they're stuck with this thing for 25 or 30 years, a lot of it's going to come out of it. But anyway,
let's wait and
to
see.
play up. Let's wait and see. Let's go to another break. Eva, back in a moment. Welcome back. Phil Tarrant chatting with Eva over at Affinity Mortgages. Now, story here on Broker Daily, units growth outpaces house prices, and unit prices are rising faster than house prices in several capitals, including Brisbane, Adelaide, Perth and Darwin. Annual growth over 10%. Affordable investor interest obviously driving this trend. And we sort of spoke up before the break, the home scheme, first home guarantee scheme put in place by the government. A lot of people sort of conceptualize that this is people buying their 5-bedroom homes, and it's not. It's got a lot of people buying apartment, and most
first-time buyers. That's what they can afford.
That's what they can afford, right?
Yeah.
And the scheme, the new scheme, put most units, from what I understand, right across Australia within the scheme, right? So you're getting a lot of price pressure now in units, and there's a huge growing discrepancy between the prices of units and houses over the last sort of 4 or 5 years. So a lot of investors I know are talking about the unit markets, and it's clear here that this driver of the discrepancy between the two houses and units prices, factored in this demand side equation of now first time buyers buying there. I would expect to see further growth.
Yeah, I would think so, because that's what we can afford. But if they're buying a unit, in their late 20s, early 30s, thinking, we'll sell and buy something else when we have 3 kids, it's going to be hard.
You reckon?
Yeah. I think a lot of people are going to come out of that quite.
In what way? Just like.
Well, if you buy a unit with a 5% deposit, that historically units don't grow as obviously quickly as a house, even though it has now because of this. In 5 years' time, when someone has a family, you can't live in a unit. Yeah, 2-bedroom unit.
So you'd have to sell the place,
but you
probably haven't had the price growth, and
you're back to square one, or maybe even worse off.
Yeah, and it's got to be dependent on what type of unit. Where, what, and if you're buying units, did you get a lot of off the plan type loans coming through?
No, we didn't.
No. Yeah, so if you're buying a unit off the plan or a brand new build unit in an area where it's growing, like you might not get, and you see it all the time, you might not get that price growth.
At all for quite some years.
Yeah. Anyway, so what's going to happen with interest rate? What's the latest, Eva, as we round out this?
Well, look,
podcast.
A month ago it was like, it's not going to happen, and now it's more like 50-50.
Based on just what economists are saying, it's going to happen. I guess it's all coming down to unemployment and CPI data, which are showing signs of easing, which may point to further reductions. But, what do the RBA say? It's shifted toward language shift towards still a little restrictive, hinting that they see room to ease policy without jeopardising inflation targets. So, same old thing.
Same old, exactly. Come on, it's Christmas coming. When
Well, they always do this, right? Because they sit there thinking about retail spending, right? If you sort of put a slight drop to interest rates in November, which is, it's the same day the Melbourne Cup is run.
Yes.
It's normally an indicator of well, let's get the retail economy sort of moving a little bit by making Australians feel slightly more wealthy.
Look, I already was 50%. I'd say it's more. I'd say it's likely.
You're saying it's likely, eh?
Yeah.
All right, we'll find out. So what does it mean? What are you doing with your clients? Would you be chatting about refinancing then on that basis?
Yeah, every time there is a rate cut, there are banks that would pass it on quickly. There are banks that won't pass it on, not the full rate anyway. And then we've seen in the past, months or two now, a lot of actually lenders passing on, or not passing on, but actually reducing interest rates outside of the RBA.
Yeah, the
And
fixed rates.
No, variable as well. Yeah, so
Wow.
that makes a big difference when maybe another bank has had 2 rate cuts while you're just waiting on yours to pass on the RBA.
To be fair to the majority to all the banks and the majority of lenders, they've all passed on the rate cut since they started getting cut. There are some sort of second tiers or maybe non-banks who have been a bit more restrictive in passing them on, and no doubt you've probably still got some clients who are sort of stuck in those type of products.
Yep.
But whether stuck's the right word, but still with those products because of serviceability. But if it does ease, if it's coming down elsewhere, they can start really thinking about refinancing. That's what they should be focusing on.
Yeah, I think we've had three rate cuts now this year. Well, another one, it's starting to make a difference in people's serviceability. So if someone hasn't had, a bit of a check, I think it's a good time for brokers to call their client and check. Say, look, it didn't work a year ago. It's likely will now.
Is that what you'd be telling brokers to do? Just get on the phone and start talking to the customers?
Yeah.
Okay. Well, thanks. You'll get your regular host back next week on Broker Daily. So hopefully I've stood in okay. Has it been all right?
It was all right.
It's okay. All right. Thanks, Eva. Good to see you. Thanks for tuning in. Everyone, remember to check out brokerdaily.au. Latest, what's happening in mortgages to help you brokers continue to do what you're doing. It's quite a complicated environment that we're operating in. There's a lot of moving parts to it. So the more informed you are, the better you can support your clients. So thanks for spending some time on Broker Daily Uncut with us today. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.